You wake up, check your phone, and it says you made $83 while you were sleeping. No boss, no clock in, just passive income. But here's the uncomfortable part. Nothing in finance is passive. It's just risk moved somewhere you can't see it. Let's pull the curtain back. Start with dividend stocks. You buy shares, the company pays you every quarter. Feels steady, responsible, safe. But where does that dividend come from? Profits. And profits depend on sales, debt, supply chains, interest rates, layoffs. If revenue drops 15%, dividends can vanish overnight. In 2020, hundreds of major companies cut or suspended payouts in weeks. The income wasn't passive, it was conditional. Now zoom out. Most passive income strategies are leveraged systems. Rental property? You're not just collecting rent, you're borrowing hundreds of thousands of dollars at variable interest rates. Your cash flow depends on occupancy, maintenance, local laws, property taxes, and the Federal Reserve's next move. If rates rise 2%, your margin can disappear. If a tenant stops paying, the bank still gets paid. The risk didn't disappear, it multiplied. What about ETFs? You buy the whole market, low effort, long term, historically 8 to 10% returns. But those returns come from corporate growth. Corporate growth comes from debt expansion, productivity gains, globalization, cost cutting. When money is cheap, assets rise. When liquidity tightens, everything reprices. You're not earning easy money. You're riding a system built on credit cycles. And here's the structural mechanic most people miss. Passive income works best when asset prices are rising and borrowing costs are low. That's not magic, that's monetary policy. Since 2008, central banks injected trillions into financial markets. Asset owners benefited, stocks soared, real estate doubled in many cities. Who already owned assets? Mostly older, wealthier households. So when you buy into passive income, you're stepping into a machine designed to reward asset holders first. It can work for you, but it wasn't built for you. And platforms know this. They market passive income as freedom. Because if you believe money can work without risk, you'll take more of it. You'll leverage more, you'll borrow more, you'll stay invested no matter what. Meanwhile, banks earn interest. Brokerages earn fees. Companies raise capital cheaper than ever. The system benefits from your participation. This doesn't mean passive income is a scam. It means it's misunderstood. It's not freedom from risk. It's exposure to structured risk, wrapped in convenience. So the real question isn't, how do I earn while I sleep? It's this. If the income looks effortless, who's carrying the volatility when the cycle turns? And when it does, will you still call it passive?